attention. I've noticed, I don't know if it's just me, but I've noticed maybe spreads under certain circumstances maybe widening a little bit, and I started researching a little bit of that. I'm going to give a few more calls to some of my inside contacts and so forth, but it seems like more and more the high-frequency traders are really kind of getting the banks upset. And what happens a lot of times is high-frequency traders are trading through some brokers, and then you've got some high-frequency traders that are trading directly through banks. And what normally happens is, for the most part, banks don't really like that. They get really upset because they're being kind of taken advantage of. And so what starts to occur is that the banks start widening their spreads so that these high-frequency traders can't take advantage of them as much. And basically, high-frequency traders, for some of you that may not know what that is basically these days you have a lot of these computer programmers who basically just do these logarithms of where they'll trade 200, 300, 400 times a day in a session. And all they're trying to do is capture a few tenths of a point in either direction. And so you find that these markets will move, but they don't move with a great deal of volume. And this is kind of how these high-frequency programs try to take advantage. But at the same time, the banks are trying to counter that. So there's a lot more of where sometimes the markets will sit for a while very tightly, moving back and forth, and it's almost the banks trying to counter what these high-frequency traders are doing. So, I mean, it does make, you see the euro bouncing back, Aussie dollar, again, just Aussie, euro yen, you can see they're bouncing very, very tough when you've got these kind of markets. And like I said, a lot of the volume or a lot of the business that's being done is through, a lot of these high-frequency traders, which, as I stated, banks don't really like. We've heard recently a lot that's going on because even in the equities market, definitely it's a big problem, and it's gone to Congress these days, and at least they're debating and trying to, I guess, do away with high-frequency trading. Overall, like anything in life, when something new comes in and it kind of challenges the establishment, it does always create those who will want to fight it, and it all depends, who has more power to either allow for the continuation of it or to seize it. I have to say that when you have computer systems these days really controlling a lot of the decisions that are done, it is a scary thing. I mean, let's face it. I mean, there's been all kinds of movies done of where computers kind of go crazy and eventually take over the world, right? And not necessarily that these computers have a mind of their own and will do so, but what they do have are bugs. Every computer software normally has some kind of bug that at one time or another probably, an outcome has not really been thought of and can create a lot of havoc. And so, we saw a few years ago when we had that big spike in the equities and across the board, 1,000-point spike or something. That was created by really a computer glitch. Although they kept trying to blame it on somebody pushing the wrong button, in the nutshell, what happened was once the occurrence took momentum, it just started activating a lot of these different computer logarithms, and we had the occurrence of over 1,000-point spike. That's really the kind of danger that we're in these days, where if you've got in general people working things, not that we can't get a big move just like we had back in '87 when we had that big Black Monday, or was it Black Friday? Well, either way. But that was being run by people, so that wasn't computer generated. So I mean, either way, things can go. Crisis can definitely take over, whether it's computer or people generated. But again, it's something that we're seeing a lot these days, and there's a lot that I'm sure we'll continue to hear about high frequency traders, especially the more and more individuals and traders are taking advantage of that. And one of the things that, for the most part, Most people these days, clever, I mean, really brilliant people can, and occasionally you find a few that are really brilliant that can do some things, from their homes. They can have access to systems that can give them the edge. Although for the most part, more often than not, you've got the big companies that can afford the, top of the line, the fastest computers, the most advanced computers, the most advanced minds to fight. It's almost like I was watching last night running a special about cheating in Las Vegas, and some of the top cheaters there. And you always find some people, man, that are extremely, really good. But for the most part, at least everyone that gets caught, you find that you always ask, well, why? Why, if you did so well, why do you get caught? I mean, one guy there, for almost 20 years or so, I mean, he got caught once and he kept going, and then eventually he got caught again. But the guy kind of took the secret to the grave. He passed away in 2010, but he wouldn't share his secret of how he did a lot of what he did. But, he still got caught. And the guy, they estimated he took Vegas for about $16 million in this, overall span of cheating the slot machines. But what it boils down to is you always get caught. At least the majority of the guys get caught, and they get caught more often because they never know when to quit. I mean, you would think once they do well, they would say, okay, enough is enough. I've made enough money. I can quit. They don't. But there's always that cat and mouse game. So in the markets, it's the same thing. You always have a few clever individuals out there who really do find ways to kind of do something new and catch and take advantage of these new things. I would say that for the most part, those who are really good at it really never go out and make it available to the masses. I mean, they do guard their secretsy stuff. I do know of an acquaintance that actually the guy is a mathematician and started his own Forex thing, and that's what he does these days, just high frequency trading. He kind of sets his computer on and lets it run and just sits there and monitors all day just to make sure that it doesn't go crazy on him. But and by the way, for the most part, the only difference is he just sits there and monitors the thing. He still watches the computer all day. It's not like he doesn't watch the computer. So it's not like you really can just set and forget. I mean, you do have to monitor it, which is, when you hear a lot of people say, oh, you can just set and forget. Well, it's not really. You do have to sit there and monitor it. I mean, if you're going to be smart about what you're doing, or unless you've got a certain amount of money that you don't really care, you just put it at risk, and it's a certain amount of money, you say, well, if I lose it, it's not a big deal. But if you're trading, as I know in this case, they're trading, with a lot of money, and by the way, they're doing it, which again, they're cutting brokers out, so they're trading directly through. They become a liquidity provider. When you become a liquidity provider, by the way, you don't get the kind of margins that retail traders do. Now, here in the States, we don't get a lot of really great margins these days, leverage. We're only at 50 to 1. If you're trading outside the country, you have as much as sometimes 400 to 1. But when you're trading in high frequency and you're a liquidity provider, because again, you really want to compete with those tight spreads. You find that that your leverage is about at a max about 4 to 1. So you really have to lay on a lot of money. It's not like you can trade with a small account. You do need a large account so that you can utilize that, and almost all of it gets used. So if you're sitting with $1 million, and you're trying to trade X amount of lots, I mean, literally, you almost use all your margin or all your money, because again, the leverage is very, very minimal that you're allowed to use. But I was looking at the results they get, this specific individual, and for the most part, we do a lot less trading. We put in a lot less hours. And percentage-wise, we can outdo what they do. The only difference is, again, they're working with a lot more money. So, in dollars and cents, they do make more. But it does require a lot of time. It does require a lot of trades. And it's still, it's not like the edge of, set and forget, as a lot of times you see some of these systems that are automatic that are presented to you, that in the retail world, when you do a set and forget, you're working with small accounts. You normally find these are very small accounts. You don't work with large accounts where you set and forget. Something that will be interesting to see as high frequency trading discussions continue to unfold. At least again, I've looked at it from that perspective of where you're doing this not as a retail trader, but really as a liquidity provider. But I do know that, again, banks have not been very pleased with that. And for the longest time, I knew when some of these high frequency trading was being done, and this was back in the mid-2000, and it was being run through some of the liquidity providers, some of the banks that provided liquidity. One of them actually is Knight. I don't know if you guys recall Knight, the one that had that big issue where they lost about $500 million in a morning, because they had a computer glitch. Talking about computer glitches, there's an example. Almost put the company out of business. In fact, it's surviving by its nails, literally holding on as the stock has taken a major hit. But that company was a major player in the equities, in the currency markets. I remember actually when I had my accounts there with them, and I used to talk to one of the main guys there, and he used to let me know about how occasionally they had a couple of high frequency traders at the time, and every now and then they would do little incidents that the banks would call these guys and complain, and they would have to call these high frequency traders and say, hey, if you do this again, we're not gonna be able to honor your trading. So it was more under control, but again, I guess as more and more of these systems and so forth have expanded, it seems like it's becoming a little bit more of a tougher control issue. And so what you see is sometimes the spreads kind of widening a little bit more as the banks are trying not to allow these individuals to do more of that high frequency trading.